Q2 at 7%, Q3 at 7.4%, and Q4 7.4%. Real GDP growth for Q1 of next financial year, that is 25-26, is projected at 7.3%. The risks are evenly balanced. I would now like to turn to inflation. Now, as anticipated, headline inflation softened significantly in July and August, with base effect playing a major role in the month of July. Food inflation experienced a certain degree of correction during these 2 months. Considerable divergence, however, was observed within the food subgroups. Now, whatever I am saying, I have given a lot of data in the footnote of my statement, which as usual will be uploaded in the RBI website immediately after my statement is, immediately after I complete my statement. For example, I just now said that considerable divergence, however, was observed within the food subgroups. So this is backed up by the data which I have given in the footnotes. And in fact, all the statements that I am making are backed up by supportive data there in the footnotes. So those of you who are interested may like to have a look at them after it is uploaded. Now, deflation in fuel group deepened on softening electricity and LPG prices. Core inflation, on the other hand, edged up in July and August. The CPI print for the month of September is expected to see a big jump due to unfavorable base effects and pick up in food price momentum. And this would be caused by the lingering effects of a shortfall in production of onion, potato, and chana dal, that is gram, in 2023-24, among other factors. The headline inflation trajectory, however, is projected to sequentially moderate in Q4 of the current financial year due to good kharif harvest, ample buffer stocks of cereals, and a likely good crop in the ensuing Rabi season. Unexpected weather events and worsening geopolitical conflicts continue as major upside risks to inflation. International crude prices have become volatile in the month of October, that is in the current month. The recent uptick in food and metal prices, and this is very important, the recent uptick in food and metal prices as seen in the FAO, that is Food and Agricultural Organization, and the World Bank price indices for September, if sustained, can add to the upside risks to CPI inflation. Taking into account all these factors, CPI inflation for 2024-25, that is for the current year, is projected at 4.5%, with Q2 at 4.1%, Q3 at 4.8%, and Q4 at 4.2%. CPI inflation for the first quarter, that is Q1 of next financial year, that is 2025-26, is projected at 4.3%. The risks are evenly balanced. Now, I have summarized our assessment of the domestic growth and the inflation conditions and the outlook as per our assessment. Now, what do this raises the question, what do these inflation and growth conditions mean for monetary policy? The developments since the last meeting of MPC in August indicate further progress towards realizing a durable disinflation towards the target. Despite the near-term upsides to inflation from food prices, the evolving domestic price situation signals moderation in headline inflation thereafter. The agricultural crop outlook is turning out to be favorable, with improving prospects of kharif and rabi output. These factors could lead to an easing of food inflation pressures, but this optimism is subject to weather-related shocks, if any. Core inflation is likely to remain broadly contained on continuing transmission of past monetary policy actions, unless, of course, there are surprises in global commodity prices. The prevailing and expected inflation growth balance. Please mark my words, the prevailing and the expected inflation growth balance have created congenial conditions for a change in monetary policy stance to neutral. Even as there is greater confidence in navigating the last mile of disinflation, significant risks, I repeat, significant risks to inflation from adverse weather events, accentuating geopolitical conflicts, and the very recent increase in certain commodity prices continue to stare at us. The adverse impact of these risks cannot be undermined, cannot be underestimated. It's with a lot of effort that the inflation horse has been brought to the stable, that is closer to the target within the tolerance band compared to its highest or heightened levels 2 years ago. We have to be very careful about opening the gate, as the horse may simply bolt again. We must keep the horse in tight leash so that we do not lose control. Going forward, we need to closely monitor the evolving conditions for further confirmation of the disinflationary impulses.